Today we discuss about insurance legal principles and terminology. Agenda of topics: we are going to contract law in insurance, essentials of a valid contract, insurable interest, duties of disclosure, remedies for breach of duty of fair presentation, cancellation and termination of insurance contracts, proximate cause, nature of perils, application of indemnity benefit policies, settlement options, specific indemnity measures, modifying indemnity, limiting factors, subrogation, salvage. This is Naga Visweswara Bhairapalli, with 17 years of experience in IT and the insurance market. I will share a summary of London insurance knowledge that can enhance your skills and help you quickly certify with the Chartered Insurance Institute, CII, for multiple opportunities in 2024. Below is a quick brief on the changes, and you can watch for daily updates on each chapter summary. The London market is a unique segment of the UK insurance and reinsurance industry. Centred in the City of London, it comprises insurance and reinsurance companies, Lloyd's of London syndicates, marine protection and indemnity clubs, P&I clubs, and brokers who handle most transactions. This market specializes in international insurance, primarily concentrating on non-life sectors, with a strong emphasis on high-exposure risks. Many of you might have aware of the basics, but as recap regarding contract law in insurance, an insurance contract is a legally enforceable agreement between an insured and an insurer. The insured pays a premium and adheres to the policy terms, while the insurer agrees to compensate for specified events such as claims. Essentials of a valid contract. Offer and acceptance. A contract forms when an offer is accepted unconditionally. Consideration. Each party must provide something of value, for example, the insured pays premiums, and the insurer promises coverage. Other key elements include intention to create legal relations. Parties must intend to create a legal agreement. Possibility of performance. The contract must be feasible. Capacity. Parties must have the legal ability to contract. Consensus ad idem. Both parties must understand and agree to the same terms. Legality and certainty. The contract must be legal and its terms clear. A contract lacking these elements is void ab initio, invalid from the start. Good faith is essential, though written documentation is not always necessary for simple contracts. Insurable interest, which is very important in life cycle. Let's discuss and know more. Not a basic contract element, but crucial for insurance contracts. Defined as the legal right to insure, arising from a financial relationship with the subject matter of insurance. The actual item insured, such as property or liability, legal relationship, must be recognized by law, creating a financial stake for the insured. Crucial part is duties of disclosure. Both parties must act in good faith during negotiations. Consumers must not misrepresent information under the Consumer Insurance, Disclosure and Representations Act 2012. Non-consumers must make a fair presentation of the risk under the Insurance Act 2015. Material information includes physical and moral hazards. Insurers must also disclose information relevant to the insured. Primary part. As part of insurance collaboration, is settlement options: cash payment, direct payment to the insured. Repair, fixing the damaged item. Replacement, common for glass insurance to minimize further losses. Reinstatement, restoring a building or machinery to its original state. Indemnity. Definition: financial compensation to restore the insured to their financial position prior to the loss. Factors influencing settlement: nature and extent of cover, and any conditions limiting the amount payable. Continuation further on. Indemnity property insurance, based on replacement cost minus wear and tear. Liability insurance, covers legal liabilities, damages and legal costs. Measuring indemnity. Various methods including agreed value policies and first loss policies. Specific indemnity measures. Marine insurance uses agreed value policies. Property insurance. Values at the date and place of loss. Buildings. Costs of repair or reconstruction. Machinery and contents. Depends on the second-hand market availability. Stock. Includes raw materials, labor, and other costs. Household goods. Typically based on replacement cost minus wear and tear with a new for old option. Key concept in insurance is indemnity, so we need the factors around indemnity agreed value policies. Value is fixed at the contract start. First, loss policies. Insured receives indemnity up to the insured sum for specific perils. Limiting factors. Sum insured. Maximum recovery is limited to the insured sum. Inner limits. Limits within the overall sum insured for specific items. Average condition. Applied when there is underinsurance. Excess deductible franchise. Amounts deducted from claims. Paid by the insured. Contribution. Insurers share the cost of indemnity when multiple policies cover the same loss. A lot of people confused about subrogation initially. Once you understand, it is very simple. Insurer's right to recover from a third party responsible for the loss. Limited to the amount paid out under the policy. Precluded in cases where the insured has no rights or in benefit policies. Salvage. Insurer is entitled to the residual value of an item if they pay out a total loss. Precluded subrogation rights. Situations where insurers waive their subrogation rights, such as subrogation waiver clauses and negligent fellow employees. This summary captures the essential principles and terminology related to basic insurance law, focusing on perils indemnity, settlement options, contribution, and subrogation. Thank you for your time. Let's catch up for next session soon. Subscribe my space for the updates and reach me at my LinkedIn for any questions. Happy learning with Naga Viswiswar by Pali.